Welcome to Buy, Hold, Sell. My name's Matthew Kidman, and today we're talking about supermarkets, Coles versus Woolies. And for years, Coles owners Wesfarmers have outperformed. Their share price for 5 or 6 years were the best of the two. But recently, the empire has struck back. Woolworths has made a comeback, and Coles, well, their prices are down. To talk about the two stocks and how they compare, I've got Matt Halp from Wilson Asset Management and Vince Pizzullo from Perpetual. Start with you, Vince. When you look at these two stocks, they're both big, both strong, great companies. How do you differentiate between the two when you're investing in them? What are the key aspects that you look at?
So what we typically look at is look for last mile positioning. So where the store locations are, because it is effectively a real estate business, where your positions are, it's your closest to your customer.
Yep.
Then we look at their logistics network, how efficiently they can move packets around the country. The lower the cost that, the more ability you have to compete. Then we look at, are they over-earning on their margins? Do they have extremely high margins like Woolies did about 3 or 4 years ago? Because that invites competitors. And lastly, we always look at the quality of the balance sheet. If they've got a good balance sheet, they can take on newcomers if any competitors come into the market, and they can battle against them and reinvest back in their business.
And what does that tell you at the moment?
Woolies now, I think, as you said, the empire, they are leveraging their network. They've got probably the lowest cost logistics network and probably the best location. So they've sort of got their mojo back.
Okay, Matt, bring you in on Woolies. Brad Banducci came in, big changes at Woolies for 3 or 4 years. It was a disaster. Everyone said the empire had fallen away. What's he done and why has it been such a success story over the last 12 months?
I think the biggest thing Brad brought was discipline to the operations. I think when he came, everyone was expecting a big transformation plan, but he broke it down quite simply, like a supermarket is doing 1,000 small things really well. And he's done that, he's executed, but we're still, probably 50% of the way through the transformation. So it's just about doing all the small things really well, and all those small things add up to a big impact on earnings, and we're starting to see that with Woolies now.
Well, he also got rid of masters and so on, so
yeah,
he made it simple in that aspect as well. But so what, Coles, they had a free run, it seemed like, for a while. Woolworths were going the wrong way, they reinvested, great product, and now they can't get any same store growth or struggling to. What have they got to do to bridge the gap?
Yeah, I think Coles obviously have had a great period. Now they've got to reinvent themselves. They've gone down this price route, down, as we all know. Yep. Now, that's phase one. Now phase two is trying to reinvent themselves or come up with the marketing and come back with some of the loyalty programs which you've seen Woolies come up with. I think they've got to focus back to what are they offering consumers apart from price. Price is the easiest lever to pull. They've pulled that. And Woolworths have pulled that too, but now they've got to differentiate themselves. So both of these companies now, once price has been reset, will look to new strategies. All
right, sticking with Coles' theme and the status quo as such, well, it might be turning upside down. We've had Aldi come here quite a few years ago and win market share, Vince. And on the horizon is Amazon, who are pushing really hard in North America to try and break into especially grocery and fresh food. Yep. Can you run us through what you think of those competitors and as the worst of that past, that competition?
Well, Aldi they arrived in 2001 in Australia, so they're a known element. 15, 16 years on, they've pretty much infilled their East Coast network. They're still relatively to slow down on the East Coast. They're now launching into South Australia and WA. So that's known, their format's known. It's not going to shock the majors, Woolworths and Wesfarmers or Coles, as to what they can do. Mm-hmm. Amazon is another kettle of fish. Now everyone's fearful of the Amazon hitting the shores. But if you look at Amazon in, say, the UK, where they've been in retail for a while, 5 odd years, and in Canada, they've had literally no impact in grocery. Yep. And I thought it was instructive that they decided to buy a business with bricks locations in Whole Foods in the US. Yep. That they're probably finding it hard. And I talked about before, that last mile. In grocery, the last mile is really important. People want to drive their car up and pick up their groceries, right? So for the two, Coles and Woolies, what are they going to be doing? They've got to be investing in their convenience and online. And because they've got the sites, they can fulfill. So that's how they're going to defend themselves against an Amazon. Whether it's in the price, I'm not too sure. You can't tell when Amazon announces anything if it's in the price. But I just look at what they're doing, what the major's doing. I think they're doing the right thing.
Okay, Matt, let's get a tip out of you or a stock pick out of the two. Woolies, even though it's a great turnaround, you said it's 50% way through, it's got quite a high multiple. It's 20 odd times earnings. What's the best? Coles or Wesfarmers or Woolies?
I think Woolworths. If you strip out Big W losses and normalise that, the PE is actually not too bad. it's probably 17.5 times.
But are we allowed to do that? Because Big W is there.
I think so, because they're in the turnaround phase of Big W. And I think it actually could trade well through Christmas, which could surprise the market. But for me, Woolworths is the clear winner for me. I think they've got more headroom for a turnaround. They've got capital management potential. They've got about 2.5 billion of franking credits, which they could return to shareholders in the if they get petrol away. And I think the sales momentum is clear at the moment. They're comping well above 5s.
And that can last for a bit longer.
And I think they can go for a few more quarters, where Coles, I think, will be flat to potentially negative over the next few quarters. So for me, back the one with the momentum and back the one which is more operational improvements.
Okay, Vince, I've got a sneaking suspicion that this might be a Woolworths fan club. Which one do you like better?
Surprisingly, Woolworths. I agree with Matt. You know, they've got the operating momentum at the top line now. That makes the business easier to manage when you've got that going. I still think there's a lot more on the cost side they can do in their business. I think they actually, now we all know they've put $1 billion into price investment and staff. Now those are the things you've over-engineered. You can probably walk back from that now and start managing your margin a bit better. So there's more earnings leverage, I think, than the market expects. And as Matt said, you know, if the BP Woolworths deal goes through, it's $1.6 billion of cash. You know, at the corporate level, they go debt-free. You know, they've got $1.80 of franking credits on the balance sheet. You know, I think they'll start thinking about that as well. With Big W, yeah, it's there, but they've put the marker in the market now with a $150 million loss. They've got to walk it back to make as less a loss as possible now. So yeah, optically it looks expensive on 20 times. Well, I think it's about 15 to 16 times actually, because they had a large bonus payment in the second half last year, about 110 mil. Whether you're going to do 6% like for likes again, I doubt. So whether that you repeat that, that's another addition to margin as well.
So not only is the fresh food fresh, but so is the share price at Woolies.